All right, let's get started. Hello, everyone. Welcome to today's webinar, the 10 Terrific Tax Tips to Top Off 2024. My name is Jonathan Harrison. I'm a partner and wealth advisor here at Sound Stewardship, and I'm honored to be the host for today's webinar. As we approach the close of 2020, this is 2024. This is the perfect time to ensure your financial house is in order and that you're making the most of whatever available tax strategies you have. So today we'll talk through some proactive tips to help you maximize opportunities and avoid common tax pitfalls we see as the year wraps up. And then if you stick with us to the end, we'll also be talking about what we know will change in 2025, and then some potential or proposed changes to watch for under a new administration in DC. So that'll be at the end. Before we dive in, I do want to mention a couple of great additional resources. Last month, we hosted a webinar navigating Medicare decisions. So if you or a loved one are nearing Medicare age 65, then there's the replay available on our YouTube channel. And next month, if you own a business or know anybody who does, even if it's just an LLC for, side hustle or something, be sure to mark your calendars for December 19th. Our webinar is going to walk through the beneficial ownership interest reports. It's something that all business owners have to get done by December 31st. So on our December 19th webinar, we'll be doing that exciting discussion. But today, you are here to talk about the exciting world of taxes. So if you have questions during our webinar, make sure you hit the Q&A button at the bottom of the Zoom menu, and we'll try to address as many of those as possible. A quick disclaimer before we get started. We're going to be sharing information and strategies that we've seen work well, but we're not your CPA. We're not anybody's CPAs. This webinar doesn't constitute specific tax advice. Your situation is unique, so please make sure you consult your specific tax advisor before you do anything. And if you're watching this replay in the future, this is good for November 2024. Who knows, where things will change in future years. But now I'd like to introduce today's presenter, who is my business partner, Matt Syverson. Matt is managing partner and wealth advisor here at Sound Stewardship, where he served clients for over 20 years. He's very passionate about helping clients navigate the complexities of financial planning with confidence and contentment, especially things like the super nerdy world of tax planning. So welcome, Matt.
Thank you, Jonathan. Awesome to be here with you and to co-present with you on one of our favorite topics, a topic that's near and dear to our hearts because we're helping every client through this each year in real time. And we know that probably most of the world did not wake up this morning wanting to talk about taxes, but you on the webinar today, man, you woke up ready to rock and talk taxes. So we're here to deliver for you today. We get that, as Albert Einstein says, the hardest thing in the world to understand is the income tax. So as U.S. citizens who live under our particular tax code, we get it. It's complicated and it's changing all the time, and everyone's trying to keep up, and we're trying to help you keep up. But our perspective is, from a worldview perspective, is taxes are simply a reflection of God's provision for you. So the mere fact that you're paying taxes as a U.S. citizen means that you have income. The more income you have, typically the more tax you pay. The less income you have, the less tax you pay, typically. A surefire way to reduce your tax bill is to reduce your income. That's usually how that works. Make zero income, you'll pay no income tax. It's as simple as that. There's a lot of gradations in the middle of that, but we just think that if you are paying taxes, that means you're being provided for. Okay, so in terms of mapping out where you need to go financially, the tax projection matters a ton, because there should be no major surprises come April of the following year when you're doing your tax return with your CPA. Proactive planning allows you to avoid that. What do you mean I owe X amount? Or what do you mean I'm having this huge refund? We should be able to avoid surprises. We can anticipate refunds or liabilities ahead of time. You don't have to wait till April. We can do that now on November 21st, but so you know ahead of time, so that we can make decisions before December 31st. Most things need to be done before December 31st of the current calendar year for it to matter. There are things that can be done by April 15th, but they're fewer and far between. Okay, so most things need to get done in the calendar year if at all possible. So that's why waiting until April when you go see your amazing CPA, it's too late probably. There's only so many things the CPA can help you do. Let's get it done now. The other thing that we're trying to determine with our clients is what's your tax tolerance? Jonathan, what do you think tax tolerance means?
How sick to your stomach do you get when you submit your tax return? Or
Yes,
or excited. You could
could
be
be
elated,
excited. Yes,
somewhere in
yeah.
the middle there.
The sick to your stomach, it's kind of like a gut check, okay? But hey, folks, based on this projection showing you owe X amount of dollars, how did that make you feel? And if you say, oh my goodness, I absolutely don't want to have to pay that much come April. Okay, would you like to do something about it? Yes, yes, I would like to do something about it. Then we help you see how to make your stomach feel better based on the adjustments that could have been made for you based on your situation. But if you don't know, commonly where this comes up is some folks say, I don't want to get a refund at all because that means they let the government have some interest-free money of mine. So they like paying a little bit of tax, not a lot, but they like to pay a little bit of tax. Others want to be break even. And still others that don't mind giving the government an interest-free loan do enjoy a refund because sometimes it pays for a trip or something like that. But we would prefer that you kind of help move toward breaking even, or it's okay to owe a little bit of tax just to get that, and we'll clean that up in April, so that you've made the best use of your dollars during the year. Because these are your dollars that God's provided you to steward, not the government's yet. Okay. So the tax projection comes down to about 3 different resources. At Sound Stewardship, we are not your CPA, nor do we pretend to be one, nor are we replacing your CPA, nor do we stand before the IRS like your CPA will. So we absolutely want you to be in good relationship with solid CPA in your community, okay? And but for every one of our clients, we are doing these tax projections throughout the year if their CPA doesn't do it for them. And then we collaborate in the spring by providing their tax letter to say, hey, Mr. and Mrs. CPA, these are all the things that we did throughout the calendar year of 2024. Please note that as they're turning in their paperwork so you can kind of match up that Roth conversion or that that HSA contribution that they made outside of their payroll. Okay, so then we love to collaborate. We love to just double check tax returns with the CPA because it's not the CPA's fault, but they don't know everything you just went through in 2024 like we would. We pushed all the buttons to make all those things happen. So of course we know your story. So we want to share that and collaborate around that with your favorite CPA. If you like, I mean, we have some folks that are Excel nerds and they will make their own projection calculators. I wouldn't recommend that because the tax code changes too much each year. So I wouldn't recommend that. But there are some free online projection calculators. You just got to be careful. They may or may not have all the bells and whistles tucked inside the formulas. So it's a thing that could get you in the ballpark, but it's not going to be real precise. So our recommendation is use folks like Sound Stewardship to help you with using the appropriate software and or ultimately let the CPA do the tax projection for you because they're going to be responsible for the filing in the spring. The other thing you need to realize after your tax tolerance is uncovered and we know, you know, who's guiding your tax situation is you probably fall into a couple different camps. You might be an itemizer, which means you're deducting more things from your tax return than the government is giving you just for showing up. Okay. And then, or you're a non-itemizer, where the government is giving you a stated tax deduction just for completing your tax return. and in round numbers, because this can kind of be confusing these days, is like for retirees over 65, if you're single, the standard deduction you get for just for showing up is around $14,000. We just met with a married couple, both over 65. I think it was like 32,900 was their standard deduction. So it's a pretty big deduction they're just walking in with before they've even calculated their giving and things like that. Okay. So it's okay to be a non-itemizer. In fact, 90% of Americans or so are no longer itemizing like they used to be about 10 years ago. Okay, so if you're on the call saying, I don't know which one I am, odds are you're probably a non-itemizer, especially if you're over 65 or over 70. You're probably a non-itemizer. Okay, so then the other thought is you're going to either be a retiree and that in that range, which is going to be, we're going to say 60 years old and older, and I'll tell you why in a moment, or a non-retiree, which would be under 60. So we don't necessarily believe that there's an age at which you should retire. Don't hear me say that. I'm just saying starting 60 and above, there's lots of new things that are available to you and you can think about that the non-retirees below 60 can't do yet without penalties. Okay, so you got to know, are you over 60 or under 60? And then are you a business owner or an employee? Okay, business owners have other levers they can pull that employees don't. Employees have a lot of levers they can pull based on what the benefits are provided, but business owners have even more because then they also control the revenue and expenses of the business. Okay, so those are some of the categories you need to find yourself in. Okay, and what I don't want you to do is, if you're clearly a non-itemizer, making another gift of $100 before the end of the year will not move the needle on your taxes whatsoever. Okay.
It might be a nice, generous thing to do.
Yeah.
But it's not a tax thing.
Yes.
Matt, you were talking about the role that the CPA plays versus, the financial planner. I did, by the way, have some great CPA jokes prepared.
Oh, okay.
But they tend to be at the CPA's expense, and so I didn't want to do that we have some friends that are CPAs, and I didn't think that they would depreciate it.
There
we go.
Where's the rim shot? There we go. Yes. Speaking of depreciation,
that's as good as the humor is going to get today, folks.
So all the CPAs on the call, I hope you depreciated that joke. That was fantastic. Here's a beta test of the visual of kind of what we're talking through here. So I'm going to try to use my little marker. So we start with oh boy, see, now I messed it up already. We start with the tax projection. That's your number one thing right here. Okay, got to do that. Then we determine you're either on track for a refund or you're on track for a tax liability. This is November 21st. You're not doing your taxes yet. Nothing's due, but now you got to do something about it. So if you're heading down the refund path, then think about which category are you in? Okay, are you over 60, under 60? Are you a business owner or employee? Because there's different things to do about a refund than the other two have. Okay. On the flip side, if you're on track for a tax liability and you want to do something about that, meaning you want to reduce that tax liability, you might say, yeah, guys, I know it's a provisions of God's wealth, but I still want to reduce what I pay to the federal government. Then again, you got to figure out what age am I? And in this particular case, we did an example of, let's pretend I'm a non-retiree. I'm 53 years old this year. So I'm considered a non-retiree. I'm also Jonathan's business partner, so I'm a business owner too. But as a non-retiree and also an itemizer, so now I got a whole bunch of other things that I can do. Technically, I've got, in my particular case, just to pick on myself, I've kind of have this little box, these boxes I'm working on, because I did just project I've got a tax liability. So now we got to open those little boxes to see what are all the treasures inside that I can take advantage of to help me in my wife's situation. Okay, so that's just a little flow chart as to what's possible based on your stage in life or your business ownership. Jonathan, is that making sense at all? This is beta testing. Put your feedback in the comments. We can flesh this flow chart out more, but
Yeah, there's just a lot of different scenarios that apply to people, and some, like you said, might be in, some overlap, but you have to know which spot you're in before you can get too specific on your own tax strategies.
yeah,
And
yeah.
it is surprising how many people don't realize that a strategy that they heard about on the radio or from a friend applies to that friend because, maybe they're itemizing, or maybe they are a business owner and you're not.
Yes, exactly, exactly. That's what you got to know your situation and know your stomach. Those are the two things to be really clear about. Okay. So then what happens if we're on track for either a high tax liability or we're in a high tax bracket? This is some examples of what can be done. Not an exhaustive list necessarily, but what we're trying to do here is reduce your taxable income if you're on track for a liability. So here's where I'm going to explain a little bit about deductions versus credits. They're very different things. So a tax deduction, if you're still owe money and you're looking for tax deductions are a reduction of your income, which will then be taxed. So, okay, deductions are reductions of income. Tax credits are dollar for dollar offsets of taxes owed. Okay, so if I let me use my pen here. If I, oh, sorry, technical difficulty. Bear with me. This is a new little technology I'm using. So if I have 100,000 of income and I triggered a $5,000 tax deduction by doing something, now I'm taxed on 95,000 of income. Did that reduce, Jonathan, pop quiz, did that $5,000 of something I did to reduce my income remove $5,000 of tax from my situation?
No,
Okay, good answer.
it
You
did
are
not.
correct. It simply reduced my income. That's where the deduction is a reduction of my income. On the flip side, if I did a tax credit, which we're going to get to in just a moment, let's pretend it's a 70% tax credit. So I gave $1,000 to something and I get a 70% state tax credit. That's a $700 offset of state taxes. So if I owed the state of Kansas $700 and I give $1,000 to a charity that has a tax credit arrangement, I just zapped that $700 of Kansas taxes by doing that state-specific tax credit. Okay, so the credits are a dollar for dollar offset, deductions are reductions of income. Okay, so as we work through the list, for the employees in the room or even employers that have HSAs and 401ks. Are you maximizing those based on your age for 2024? You've only got a few more paychecks left, maybe 1 to 3 paychecks left to make that fit within your payroll. Now, pop quiz though, Jonathan, can you fund HSAs after December 31st for 2024?
Can you? I'm the only person to do the pop quiz with. Why do I get all the questions?
Yeah.
Yes, you can up till April 15th
Yeah, and we did
of the
not rehearse
following
this.
year.
I'm just going to show you how much Jonathan knows, and you're just going to blow your mind. So yes,
You'll see me Googling on the other screen over here.
okay. No Googling allowed.
Yeah,
So
some things like HSAs you can do up till April 15th. However,
yeah,
you also have 401k on that screen. And for most
yeah,
people, December 31st, that's when they got
yeah,
to get their 401k
yeah.
contribution in.
For the employee, you've got to get it in before
Yeah.
December 31st. If you're the business owner, you can make a profit sharing contribution to everyone according to a particular formula after December 31st, which then will reduce your profit because you shared it with others. Okay. Speaking of business owners, if you're on track for tax liability, are there any legitimate expenses that you're probably going to pay in January? So why not bring those into December before the year gets past us? So don't get cute and go buy, $100,000, Lincoln Navigator before the end of the year to try to reduce. Don't do that to yourself. Just, is there some legitimate stuff that we're going to need in the first quarter of 2025 anyway? But let's just take care of it now. We have the cash. That could help your situation. On the giving side of things, here's where we support giving 100% whether you itemize or not. God does not care if you itemize. What does he want? He wants a generous heart. So get the charitable dollars out there working in your community and around the world. There's lots of issues to take care of through charitable giving. If you itemize and you have and there's more that you'd like to give, like you, for example, you'd like to help the folks in Western North Carolina from Hurricane Helene. They're still needing help. Okay, I've already given to my church this year. I've taken care of that. But yes, I would like to do more, especially because I'm on track for a tax liability. So let me help those folks rather than pay more tax. As far as the bunching strategy, this also relates to charitable giving. So let's say in 2024, we are itemizing, but maybe I won't next year. So what you can do is put together 2 or 3 years worth of giving in one calendar year. And then next year, you just enjoy the big fat standard deduction and keep going. Okay, so it's a way to, if you're in itemization land this year, you can add more and keep itemizing. And then store those charitable dollars in your donor advised fund to give away later. Okay, that's a whole nother discussion, but let's talk about bunching if you have resources to do that with, especially with stock prices so high as we roll into this talk. Who knows what's going to happen in the next 45 days, but for now, stock prices are high. Let those gains do your giving for you. Give the stock directly to the charity or directly to your donor advised fund so that you enjoy the tax deduction, but avoid all the capital gain. And the gains are there to help you do that. If you're a retiree over 70.5 and have an IRA, you can give directly from your IRA to your charities that you care about and not pay any tax on the distribution. Jonathan, typically when you pull money out of an IRA, is that taxable or not?
Taxable.
Thank you. However, there's been a rule almost since 2006. Most people haven't heard of this, but we do it all the time. Qualified charitable distributions allow folks over 70.5 to give IRA dollars directly to charity, no taxation as it comes out the door. It's one of the few ways to get money out of IRAs tax-free. And for those of you that are concerned about meeting your required minimum distributions, it counts toward the RMD. It's the best thing since sliced bread for those in their 70s and older who have an IRA and are givers. If you're not giving from your IRA and you're in that zone, you need to be, and we can help you do that. Last thing to consider. Yes, Jonathan.
Oh, sorry. With a qualified charitable distribution out of your IRA, how does that impact your income for purposes of like your Medicare premiums?
It doesn't impact it one bit.
What?
It's amazing. It leaves the account, but it doesn't count toward your income. It's the greatest thing ever. Okay.
I did have a comment on the bunching strategy with stock. Just talked to somebody this week who they have a lot of company stock that they've received over the years that's grown a lot, and they're nervous because it's appreciated so much and is a pretty big part of their net worth.
Yeah.
But on the other hand, they're also, and they want to diversify, but on the other hand, they're also big givers, but they've been writing checks to charity for years. And so we talked about this idea of using a donor advised fund and pushing the amount that they were going to give in from the stock into the donor advised fund. The donor advised fund gives to the church and charity just like they were doing already. They can diversify out of that stock without paying any of the tax on it. And then the cash that they were giving to the church every year, it goes back into their portfolio to diversify and buy new things and whatever they want. A great way to do something. They were already doing it. It's just allowed them to use different pockets and save a ton in taxes long term.
Yes. So we can do that in our sleep, folks. So that's a wonderful strategy we can use for those that have highly appreciated stock outside of IRAs and Roth IRAs. That's in a open to the air in a brokerage account. We can do that all the time. It's great. Now, tax credits don't, if you've had something installed on your home that qualifies for an energy credit, great. Keep the receipts. It has to be installed to be able to get the credit. Just don't forget about that. It's probably too late in the year to get something done unless you already had it scheduled. There are electric vehicle tax credits. Again, if you're thinking about getting an EV anyway, have the cash to do it, there are credits available, but there's some very specific makes and models, and there's specific amount of tax credits that are available at the federal level. And you remember, tax credits are a dollar for dollar offset of the tax you would owe. Okay, so you have to have tax to bump up against the credit to make it go away. All right. On the state side, Kansas and Missouri, which is where we kind of hang out between those two states, there are lots and lots of different state tax credits that you can take advantage of. So as the phrase implies, that only impacts the state tax liability you have. It doesn't impact the federal, which is fine, because we can even trigger a state refund through a tax credit, even though you owe a little bit federal, and they can offset each other by the time you get a check from one and have to pay the other. Okay, so as a quick example of how a state tax credit works, and this is from our friends at Relentless Pursuit. They just made a nice little drawing for their donors. So let's pretend we do this $10,000. Oops, I might have been in the wrong spot. Let's do this. Oh, Jonathan, I'm showing my age here. Sorry. Let's do this $10,000 gift. It can be out of pocket or with stock. I mean, this particular example is reflecting a cash gift. And that particular charity is offering a 55% Missouri tax credit based on what you just gave. 55% times 10 grand. Okay. So then what you're going to get for that, the 45% that you get to deduct goes here. So that for those itemizers, you know, they have you in a 37% tax bracket. That's the highest federal tax bracket you can have. So someone with high income that wants to give 10 grand, they're going to get 5,500 knocked out of their Missouri taxes. They're going to get a deduction at the federal level of 1,665. There's going to be another small Missouri tax deduction here. So at the end of the day, your net out-of-pocket cost to donate 10 grand was about $2,600. Okay, when you run it through the math. And then the higher, there are others that get us up to 70% tax credits. Okay, then some go to 100, but all for the state. So rarely you're going to get a federal tax credit that goes to 100. That would be amazing, but they don't exist really.
And these are, sorry, real quick comment. These are so state specific that,
Yeah.
you know, it's and so situational. Did you know, Matt, that there's actually a Hawaii tax break for having a certain type of tree in your backyard if you take care of it? It's a rare tree that Hawaii wants to, but in Missouri and Kansas, where a lot of our clients are, I just talked to a client yesterday or this week who was saying, you know, I don't hate taxes, but I wish I could control a little bit more where my money went to. And we said, well, at least in the state of Missouri where this client lived, you have this tax break option. What's a charity you support? And we just looked up their charity and Missouri tax breaks, and there was a 70% credit. So they could send $10,000 to this Missouri charity and save $7,000 of Missouri tax, not quite like for like, but almost, to actually redivert some of those resources. There, if you support a private school in Missouri, there is a $10,000 100% tax credit for a lot of schools in our area, a private school, not for tuition, but for donations. So things like that, there's all these different, both Kansas and Missouri have a ton of these little, usually related to a charitable cause or something like that, that you might be able to benefit from.
Yeah, exactly. Now, imagine if you paired this gift with, or you funded this gift with stock. Now, you not only avoid all the gain on the stock, but then you also get the tax credits and the deductions. So now
this is getting too crazy, Matt, too spicy.
I mean, it sounds too good to be true, but it really is
exciting.
For those of you that bought NVIDIA way back when, and now it's $1 million a share, here's your opportunity. Okay. Anything that's highly appreciated that you've owned over a year and the charity has the capabilities of receiving stock, pair that together all day long. You take a lot of bites off the tax apple when you do that. Okay. Now, so that was all on the liability side of things. And there's more where that came from. We're just kind of whetting your appetite with some of the high level ones. Let's flip to the refund side of things. Or what if you're in a lower tax rate? So for example, the 65-year-olds we helped this morning, they were on track to basically break even. I think based on all we did throughout the year, they're going to owe the federal government $28 and they're going to get a $45 refund from the state of Kansas. And their average tax rate was 11.7%. We're like, that's fantastic. So we said, you can coast into 2025 and not do anything more. Or one thing you could do to reduce your future tax load and reduce your required minimum distributions is go ahead and convert some of your IRA to your Roth IRA. Okay. When you do that, you pay tax on the movement from the IRA to the Roth IRA. So when it goes from here, when it goes from here to here, you do need to pay tax on that amount. But then you're not taxed on it moving forward as long as you follow the rules moving forward. Okay, so we took them from an 11.7% average tax. We converted some of their IRA to Roth and brought them up to a 13.5% average tax rate, and kept them all within some nice thresholds that didn't trigger any new tax. It was just a great little thing to do, very easy to do before the end of the year. Okay. Speaking of Roth, if you're contributing to either workplace retirement plans or IRAs or Roth IRAs personally, and you're in a lower tax rate, absolutely lean into Roth, or at least a mix of both. Sometimes people get stuck in the idea that I've got to contribute to my 401k on a pre-tax basis. So shake out of that, especially if you're the non-retiree that has a lot more years to let this run. Absolutely be funding Roth arrangements as much as possible. Ask your employer, do you have the ability to contribute to a Roth 401k, Roth 403b, Roth, you even have Roth simple IRAs if your employer set one up now. Okay. So be sure to Rothify your situation moving forward. But Jonathan, what's the rub of leaning into Roth each year? If we're using Roth more and more, what's going to happen to our taxes?
Well, in the year that you send the money to the Roth, you don't get a deduction for that.
Correct.
Is that what you were looking for?
Yes.
Yeah.
Yes.
Well, and I know
Yeah.
our attendees are, super tax pros who've done this, left and right. But just to define, what's the difference between like a pre-tax IRA or a 401k versus a Roth 401k or a Roth IRA? What are those differences?
Yeah, exactly. So when you contribute to a pre-tax 401k or a traditional IRA, remember that's considered a deduction or a reduction of your income. So if you contribute $5,000 to a 401k, that's a reduction of your income by $5,000. If you contribute those same $5,000 to the Roth, there's no deduction for that. So you're actually paying a little bit more tax now to then have the pleasure of not paying tax on that in the future, and no required minimum distributions in the future. Okay. So the pre-tax equals deductions essentially, or reductions of income. The Roth, either no reduction of income, or if we're converting, it actually increases your income. So this morning we are intentionally increasing their income in order to do the Roth conversion and then enjoy tax freedom from that down the road.
One question that often comes up is when does it make sense to do Roth? You mentioned a low tax rate. That was pretty obvious. But what about somebody who finds themselves in a high tax rate? Do you ever have clients in a high tax rate who should be using Roth?
Yeah, we have a variety of clients that are making 7 figures of income, if not approaching that, yearly. Now, let's pretend they're over 50, so they can contribute $30,500 to their pre-tax 401k. Well, if you're making $1 million of income, Does a $30,000 deduction really move the needle at that level? The answer is no. So if their tax tolerance is such that that 30,500 isn't meaningful enough to me, I'm going to put that in the Roth 401k because I know that's going to be much more beneficial down the road than getting a little bit of a deduction today. Commonly, those high income earners are also big givers. So the giving we do with them is at least in the six figures, which blows the doors off of the amount they can put in their Roth 401k, depending on if they're a business owner or the employee. But so that's the idea. Even if you have high income, it still might make sense to do the Roth 401k, 403b, because it's still growing tax free, and you're creating other deductions that help you anyway. Okay.
You know, a new law in 2020, the Secure Act, changed how IRAs are inherited. Particularly, most recipients of inherited IRAs, when the client and their spouse pass away, have 10 years to distribute all of that out of a pre-tax 401k or IRA. And that, I think, has made it even more beneficial for people to do Roth because it still has that same 10-year rule, but the recipients don't have to pay tax on all that as they distribute it. For somebody who inherits a big IRA, that I have clients who have inherited millions in an IRA that have this new 10-year rule, and
Yeah.
it's put them in the top tax bracket for every one of the 10 years because they don't get to stretch it out like the client did over
Yes.
their life. If the family member would have done that in Roth, it would have saved literal hundreds of thousands, probably over $1 million in taxes across those 10 years. And I don't know that they got that much of a deduction when it went in.
Correct. Yeah. So sometimes we'll pair the tax consequences also with the estate planning considerations. So that they bump up to each other all the time. Okay. So not only think about your annual income tax situation, but also what do we want? How do we want people to receive these dollars in the future? Whether it's me receiving it as the account owner, or my wife or heirs receiving it down the road. What kind of tax do we want them to have to pay on it or not? And we're fortunate this year. We were unfortunate to have lost a longtime client who passed away in his 80s, but we had helped him convert his IRAs over time. We had over $1 million in his Roth IRA, and that's what was going to 10 different beneficiaries. And so every one of those 10 are receiving portions of that Roth IRA completely tax-free. They still have to kick it out in 10 years, but every dollar that comes to them is tax-free. So it's a pretty amazing gift to provide to multiple generations with no tax consequences to them. Pretty neat. Okay. So the next thing is called gain harvesting. I'm sure you've got some highly appreciated stock. This also means from a brokerage account where you're intentionally bringing capital gains upon yourself. After you've done your giving of highly appreciated stock, then you also might consider selling highly appreciated stock, intentionally taking the gain now, and then redeploying that, rebalancing, or even resetting your cost basis. When you sell something at a gain, you can buy it right back anytime moving forward. It's only when you sell it at a loss that you have to wait 30 days or 31 days before you buy it back. And then on the business owner side of things, if you're on track for a refund, can you defer, any December expenses into early January, just so you aren't deducting anymore? Or can you accelerate income into December so that you're soaking up that refund? Just a couple of different things. All legitimate. Don't get too cute with that. Just appropriate things. Don't get edgy. Just some low-hanging fruit. It might be sitting right there for you. Okay. Now, so that was 2024 blocking and tackling, and we're absolutely here to help you with that, along with your CPA. Jonathan, help us with the 2025 updates that are coming along.
Yeah, let's talk 2025 now. Let's pretend you already have your tax projection in place. You know what you're on track for April. 2024 decisions are all made. What about 2025? We'll start with what we know already, which is the table on the slide. Most things have gone up just a little bit, like 401k went from 23,000 to 23,500 if you're under age 50. If you're over age 50, you can do an additional 7,500, but there's a new rule that's just coming into effect for 2025. That's if your age is 60, 61, 62, or 63. So 60 to 63. I don't know why they picked only those years. Then your catch up is, instead of the extra 7,500 that you could put in your 401k, you can actually go all the way up to an extra 11,250. So that's a brand new rule for 2025. So if you're getting ready to, as you roll into 2025, make sure your 401k elections reflect where, if you're trying to hit the max, these are the numbers that you're trying to get. 23,500 for age 50 and below, and then depending on whether you're age 15 above or 16 above, you may have a different number. IRA contribution limit stayed the same for 7,000 per person for an IRA or Roth IRA, and then an extra $1,000 if you're also age 50 or above for those. Those stayed the same, and then there's some HSA and FSA numbers on the board. Those we know about, as well as the tax brackets. But if you're ready to do some speculation, there's also some things we're wondering about with a new administration. The Republicans have both the Senate and the House and the White House. So there's a lot of questions around what is going to happen with taxes, particularly because a really big deal that was going to impact is that in 2017, the Tax Cuts and Jobs Act was enacted to dramatically change the tax code, and it had a sunset where all those rules that had changed were going to revert back to the old rules at the end of 2025. And so now the question is, well, are we going to revert back to the old rules or not? Now that we know Republicans will be in power, they were the ones who enacted the Tax Cuts and Jobs Act in 2017, very likely that those changes will probably not be just automatically extended, but probably will be, many of them will be extended. So the table on here is, this is all speculation. Matt and I, we don't know. We don't work in DC. We don't know anybody who works for any of the administrations. But this, if you use the QR code, you can get a larger version of this. But it shows you, for all these different items, what are the ones that speculators think will change versus won't. For instance, we don't think the tax brackets will change much. They did in 2017. We don't think the standard deduction will change. That dramatically increased, like Matt said, so that now 90% of people don't itemize because that number went up so high. But we do think it's highly likely that one of the deductions, it's called the SALT deduction, the state and local tax, used to be whatever you paid to Kansas or Missouri, whatever you paid to your local municipalities, you could write that off as a deduction. Now that's capped at 10,000, which for somebody in especially higher income, like that, they may be doing easily 25 to 50,000 to state and local tax that they don't get to deduct, and because of that cap, it's likely that that's going to change. We just don't know what that looks like. There's been proposals where maybe it just goes to 20,000 if you're married filing jointly. Maybe you get rid of it entirely, but both Republican and Democrats have wanted it to change. There's a lot of different ideas on how it might. So that's really the biggest one that everybody thinks will change. But that might mean that, for instance, the alternative minimum tax, which doesn't impact barely anybody now, that might capture back some of those that you can see this little thing says it's tied to SALT cap negotiations. So that's likely to change. The other big one is down there, you see it says estate tax low. A lot of families over the last couple of years were concerned because right now, Matt, I have a pop quiz for you because you're the only person who can answer on the line. Right now, if you and your spouse pass away, a married couple, how much can they pass on to their heirs without having to pay an estate tax in 2024?
Yeah, combined, it's close to $25 million.
Which is a lot of money.
Yeah.
It does. The state tax doesn't impact very many households anymore. If the sunset happened, that would drop below, I think it's $7 million per person. it would drop dramatically. Maybe it drops dramatically. So some families were accelerating transfers to the next generation because they were afraid of that, and it's very likely now that those higher limits will just continue on and not automatically cut back. So those are like I said, we don't know, but we think the biggest changes will be around how much you'll be able to deduct from your state and local tax, which means some people who were standard deduction, if they pay a lot of state and local tax, might become itemizers again. And those who have estates somewhere in the 5 to 20 million range should have been maybe wondering, well, how much of this is going to get taxed? At least now it looks like that'll get extended as well.
Good.
So there you go.
Okay. Good speculation. Well, we'll see what happens. And that's coming from our source called kitsis.com. That's a financial nerd that a lot of financial advisors follow, that puts together a lot of good information about current situations in the future, and there's a lot of good planning information that we can lean on here and there. So
we sure hope we're going to find out the answers in the first half of the year and not on December 29th, like Congress likes to pass a lot of these big tax bills.
Yes.
It'd be great to know, on April 15th.
Yeah. Jonathan, I know we've been quizzing each other a lot, but are there any other questions on the call? Yes.
Oh, so many questions. You guys were just sending them in, and they were so complicated. We're going to have to defer them to your CPA. I'm sorry, but we answered all we could, folks. No, I think we covered a lot.
Yeah.
I don't have any more.
Okay, very good. All right. Well, if you do, call your CPA or whoever you consider your tax advisor. Call us to help you with a tax projection, which is a prediction of what's going to happen, so you can avoid any surprises. If you're an existing client of ours, this is just included in our annual flat fee. There's no extra cost for this, and we want it to be accurate. We want it to be right, and we want you to coordinate well with your CPA come springtime. So keep in touch about this. There's a lot of moving parts, and if you're a business owner on the call, make sure to join us on December 19th, 2024, noon Central, for a discussion on the beneficial ownership interest requirement for FinCEN. Okay, that's a Corporate Transparency Act. It's a new law. It's not getting talked about enough, but if it doesn't get done before December 31st, the threat is financial penalties and/or prison time for those that don't get it taken care of. Okay, and we can support you through that. You've got to push the buttons, but we can support you through that. It doesn't take long, but we'll show you how to do it come December. Okay, anything else for now, Jonathan?
I do have one goal, and that is that clients don't have prison time. That's one thing
Correct.
I like to really shoot for.
Yes, we are avoiding. We've had a great track record for that. No prison time has happened on our watch, and we're going to keep that streak going.
Is that a differentiator? Do you think that's one thing that makes Sound Stewardship unique?
I don't think that's one of them, but
okay.
But rest assured, we're not going to head that direction.
December 19th.
December 19th. Come check it out. All right. Any other questions? Email, call. We are here for you. Thanks for joining us today, everybody. And may all your tax projections look great.